When people ask me what I do for a living, I reply that I am a day trader. They immediately assume I trade stocks. Well, isn't that what everybody trades? I usually get a quizzical look in return when I say that I trade futures and commodities. And on occasion, I've had to go into a little further explanation. Futures are contracts between buyers and sellers. It is a standardized agreement that commits the parties to buy or sell goods of a specific quality at a specific price for delivery at a specific point in the future. Futures contracts offer an assurance of future prices and the availability of those goods. They also provide some stability in an unstable and ever-changing business environment. This item or underlying asset being bought and sold may be an agricultural commodity, an energy commodity, a metal, a financial instrument, or a foreign currency. The simplest way to begin understanding the nature of a futures contract is by example. So picture this. A farmer has just completed planting hundreds of acres of corn. He plans on maintaining that crop during the summer, harvesting it in the fall, and expects to make a profit on the sale of the corn. But at planting time, this farmer has no way of knowing what the price of his crop will be when it is harvested in the fall. If this farmer sold a futures contract, he would agree to deliver his corn in the fall for a pre-specified price. Not only would he receive cash in the spring in return for his commitment, but he also received an acceptable price for his crop, even if the market price subsequently fell because of an unexpected oversupply of corn. However, in exchange for this, the farmer has given up the chance to get a higher price for his corn in the event of drought, for example, which could cause higher demand for his corn. He received the same fixed price for which he had contracted. In the latter case, the farmer would have netted more profit if he had not sold the futures contract and had waited to sell his corn on the open market after the harvest. But many farmers prefer not to gamble on the corn market. Farming is risky enough without adding in the risk of changes in market prices. So farmers are typically looking to lock in a value of their crop and are willing to pay a price for that certainty. They give up the chance of higher prices in return for protection against much lower prices. Now, who would be a buyer of that same futures contract? Who has a need for that corn and is willing to accept delivery of the corn after harvest? Possibly a food manufacturer like Del Monte or Green Giant. Just as the farmer is trying to reduce risk by selling corn at a predetermined price, these manufacturers are controlling their risk by buying the corn at a predetermined price. Now, these contracts are not made directly between the buyers and sellers. The farmer who sells a futures contract and commits to deliver his corn in the fall does not make his commitment to a specific corn buyer. Rather, he makes it through a clearinghouse of the futures exchange by utilizing his broker. The clearinghouse operates between the buyer and seller and guarantees that both buyers and sellers of futures contracts will receive what they have contracted for. Without clearinghouses, traders would have to interact directly with each other. They would first have to find someone willing to take the other side of the contract. Also, this would introduce concerns about the credibility of each buyer and seller. Will they commit to what had been agreed? One party may be untrustworthy or have a history of delivering an inferior product. Because these clearinghouses exist, the farmer does not have to be concerned about the financial stability of the buyer of the futures contract, nor does the buyer need to be concerned about the status of any particular farmer's crop. Futures trading is what some call a zero-sum game. This means that for every winner, there is someone who loses an equal amount, at least on paper. But from a different perspective, futures trading may result in a positive sum. Of course, both sides expect to gain or they would not trade. Or more simply put, the loser may be content with taking that loss. That is because traders may also use the futures markets as a form of insurance. Let's try to explain this with another example. Most manufacturing companies require raw materials in which to make their products. But the future cost of that raw material is unknown, so they may choose to buy a futures contract to lock in a price for some portion or all of its raw material requirements. The contracts are the same as physically buying those materials and storing them. Now, if prices rise, the futures contract will also be more valuable. The choice can then be made whether to sell the contracts for a profit and then buy the materials at the current market price, or else accept delivery of the materials from the seller as agreed upon and purchase less on the market. Either way, the cost of raw materials is less than if no futures contracts were purchased. But now what if the price of the materials drops after purchasing the futures contract? In that case, the company simply loses some money. But that same drop in price that causes that loss for the manufacturer also allowed the manufacturer to pay less for the additional materials it needs. Keep in mind, the reason for purchasing the futures contract was to protect against something bad happening, a rise in price. Since prices fell instead, the loss on the futures contract is the same as the cost of insurance. Just like you or I having car insurance and never being involved in an accident. We are protecting ourselves from something bad happening and are willing to pay a price for that protection. So this practice of buying and selling futures contracts in order to remove or reduce risk is called hedging. It is estimated that about half of the participants in the futures markets are hedgers, attempting to control their risk. So who trades the other half? The answer is speculators. Speculators trade futures contracts solely for the purpose of making money. They have no intent on actually delivering or taking delivery of the underlying commodity. These traders are willing to assume the risk in which the hedgers are trying to minimize. The futures markets could not exist solely of hedgers. Speculators are a key component to the markets because they provide liquidity. Without that liquidity, it would be much more difficult and more expensive for the hedgers to offset their risk. So because speculators are willing to assume risk at a price allows others the opportunity to reduce their risk. The list of available futures markets is quite extensive. However, some are much more liquid than others. The agricultural sphere includes corn, soybeans, wheat, cattle, hogs, cocoa, pork bellies, cotton, coffee, orange juice, sugar, and even lumber. Currency futures may include the euro, Canadian and Australian dollar, Japanese yen, British pound, and the Swiss franc. Metals and energies cover everything from gold and silver to crude oil and natural gas, even weather futures. Futures also exist on stock market indices, like the S&P 500 and the Dow Jones Industrials. Stock index futures not only make a useful hedge, but they also offer an alternative to actually buying stocks. Since the futures move in sync with the prices of the underlying stocks, it can provide the same percentage return as owning the stocks outright. So, personally, why, as a speculator, would I choose to trade futures instead of stocks? What are the advantages? To this, there are multiple reasons. First, I can sell a future or short it just as easily as buying it with no involvement by my broker. If I wanted to short a stock, the shares I'm selling would have to be borrowed by my broker, and I would incur costs associated with the borrowing of that stock. With futures, there is no borrowing. Second, with a margin account, I can buy a future with having only a small percentage of the full value of that future on deposit in my account. I can do the same with a stock margin account, but the remaining amount of the stock purchase would be loaned to me by my broker, and I would again incur costs associated with that. Those additional costs are not incurred with a futures margin account. Third, futures offer leverage that stocks do not. I can control more with futures with less capital in my account. However, leverage can be like a double-edged knife. Without proper money management, losses could easily exceed the account balance. So many people would not perceive this as an advantage. Finally, and most importantly to me, the capital gains tax structure benefits a futures trader. All capital gains from futures trading are taxed at 60% long-term and 40% short-term, regardless of how long they are held. If I should buy and sell a gold future in the same day and make $1,000, then 600 of that would be taxed at my long-term capital gains tax rate, and the other 400 would be taxed at my short-term rate. With stocks, I would have to hold that stock for 12 months before I would be eligible for the long-term rate. Anything less than a year would all be taxed at the short-term rate. There are a few other advantages, but these are the major ones for me. I hope this helps to clarify how futures can be used as an integral part of your trading portfolio. Thank you, and may all your trades be successful.